Good afternoon, everybody, and welcome to, and thank you for joining this live webinar on surface transforms hosted by our very good friends at Hardman, and thank you, Hardman, for facilitating this, this discussion. My name is David Bundred, and I am the chairman of Surface Transforms. And I've got with me today Kevin Johnson, who's the chief executive of the company, and Michael Cunningham, who is the Chief Financial Officer. Just some things about the presentation in words of setting the scene. This is going to be a somewhat different type of presentation from the one we normally give to shareholders, because in normally shareholders, we presume nothing about their knowledge of the company. We talk a little bit about who we are, what we do, and all the rest of it. We're going to assume an assumption of the company that you know the company's about, because the background to this particular presentation is we've just had two very good, very successful, oversubscribed, and that's the point, oversubscribed capital market days in our factory in Knowsley. And the purpose of today is to give everybody the chance to hear what was said at those presentations, so all our shareholders are on the same page, and to give those who weren't there at the opportunity to ask the questions of management of those who were there. Of course, we're going to cover some of the updates as well, since a while we've spoken to the to shareholders, but the main purpose is yesterday's Capital Markets Day. So, Kevin, over to you, and I think you're going to begin by sharing screen.
The first slide is just the usual disclaimer. We will be talking about things that are forward-looking, so it's not meant to be any financial advice. You guys can make your own mind up about what we say. It's worth talking about, we said we weren't going to do an in-depth thing about the company, but to put everything into context, I suppose this is. And we live in a what arguably a more rapidly changing automotive market than ever before. And that's principally with the change over from combustion engine cars to electric vehicles. And that change is significant for the whole industry, but it's also significant for brake discs. The desire to have weight reductions, the desire to have cars that are heavier, go faster, is ever changing and ever increasing the demands on brakes. And that's actually good news for carbon ceramics. They can deliver to the needs of both combustion engines and particularly to electric vehicles as well. So we see that change in the market as good news for ourselves. Coupled with that, supply security is a very topical item. I'm expecting questions perhaps from you guys on supply security. And being one of only two players in the market, it means supply security for carbon ceramic brakes is a topical question as well. And we think we're in good shape being one of those two players to be able to give our customers the option of security of supply. Environmental factors going alongside the trend towards electric vehicles. There's another trend in this marketplace as well for automotive, for reduced emissions, reduced pollution. Obviously with the removal of the engine, that removes a lot of the pollution from cars. But the focus on cars then is on the wear parts, principally the tires and the brake dust. And it's well known that ceramic brakes offer a reduction of about 50% in brake dust generation, and therefore reduce the pollution by about 50% as well. So it's very good news for the industry that ceramics can offer that improvement. And the last trend is about extended service life. And over the last 2 decades, cars have been getting better and better in extending their service life between parts being needed to be replaced. Arguably, parts are now talked about as being lifetime parts. However, iron brakes are still a service part. They get replaced regularly through the life of the car. But if you swap that out for a ceramic becomes a part for life rather than a service part, and that just fits in that trend very, very well. So we've been responding to those market trends and meeting our customer needs very successfully over the last few years as one of those 2 players in the world that can offer carbon ceramic brakes. Our products are market leading and they have a strong fit with the customer as well. And that's principally due to our proprietary process and products that we can produce. And we talk about our process in a bit more detail later on. And I will highlight where we see our competitive advantages over our competitors. But it's not just me saying that, our customers do their own testing and tell us that as well. And there are significant environmental benefits, as I've just said, not just in the brake dust pollution, but also from weight saving and taking weight out of the car. The carbon footprint for the use of a carbon ceramic brake over the lifetime of the car is significantly better by taking weight out on the brakes. So that's resulted, if you like, in us delivering sustainable and resilient growth over the short and long term. We've now got many multi-year contracts in place with good margins. We've gone into series supply this year with Aston Martin for the Valkyrie and with Koenigsegg for the Jesko. And another key event for us this year is the launch of OEM8's car, which is happening sometime at the end of spring. So with those numerous contracts, we've been announcing particularly some more of those in the last sort of 12, 18 months, and our order book now is well over 180 million. And that spans about 10 contracts over multi-years, and it's across 5 different vehicle manufacturers. And as we said, we've got a strong ESG story, arguably strong on the product side, and I'll talk a little bit about the process side as we go through in terms of the opportunity we have to improve our ESG. But really, in terms of where the business is at right now, we've de-risked the business significantly in winning those contracts, in positioning the company as we have in terms of the marketplace. It is all about the execution now, about delivering against those contracts and meeting the demand that we can see in front of us. And that's really what the focus of the Capital Markets Day was over the last couple of days. And I will talk about that in detail. But before I do, I'll hand over to Michael. He'll just briefly talk you through last year's numbers.
Just looking at the results from last year, you can see that our sales were lower than we had initially intended, and that was due to the unexpected furnace issues that we had in Q4 that were communicated to the market. Our Valkyrie deliveries continued during the year, and we continued with good development income for the programs that we've been awarded. You can see there that also our retrofit and near OEM sales remained flat through the year, but would have been better had we not had that furnace issue. Our gross profit was in line with our expectations, maintaining circa 65%. And we expect that to increase as that OEM Cell 1 equipment continues to come on stream and our volumes increase. Loss after tax was in line with expectations. We've obviously had a significant increase in administration costs over the year for 2020, with significant additional headcount recruited, and we had very low levels of coronavirus job retention scheme income in the current year compared to 2020. Of those administration and development costs, you can see that we increased our R&D supporting the current contracts. We have used quite large levels of material improving our processes off to ensure that we're ready for start of production and commissioning those furnaces that have arrived on site. As far as OEM3 is concerned, we spent a lot of money on the testing for that, and that's now complete. We've increased headcount, obviously in line with our launch plans, and that's been progressing well with no real issues about recruiting people. Net cash in operations obviously has increased significantly alongside that headcount and R&D, and we have increased our inventory as we start stocking up ready for programs commencing. And finally, we get to the cash balance, so that we have a healthy cash balance at the end of the year at 12.9, nearly 13 million pounds. Of that, 3 million pounds is in letters of credit for furnaces that we have being delivered, and we expect, as usual, to receive circa 650,000 of R&D tax credit in the coming months. And obviously, the highlight of the year financially was that heavily oversubscribed placing an open offer in February, where we received in excess of 19 million pounds post fees.
Just to put some context around what we talked about in the Capital Markets Day, we have all of our models, whether they be contracts in the green, carryover models, and carryover is where the part has already been engineered and approved by a customer and is in their parts bin, and they just take those parts out of the parts bin and put them on a subsequent model. And there's some prospective contracts there as well in red. And you can see that if we translate those into a revenue over the coming years, we talk about revenues growing quite rapidly over 22, 23, 24. And if you look at the light blue and the dark blue and the hash line for all 3 types of contract status, we can easily get to our footprint for Knowsley and Liverpool, which is about 75 million, and we can breach that in 2025. So really, as I said at the start, it's really all about us delivering to that customer demand. And to do that, we need to build our capacities up, and we have been doing that. And we're doing that in sort of 3 phases. Phase 1 has been the development and the progression to delivering 20 million of capacity revenue, and that's coming on stream this year in full. And now the thing to remember here, it's all well and good having 20 million and sales that are coming close to that, but it's really about having 20 million that is resilient manufacturing capacity. And that resilience comes from the gap, if you like, between what our sales we expect to get in the year and where that line is. So there isn't a lot of resilience we have this year. Now that starts to come in as we build towards, and that's what we did our fundraising for last year, building capacity up to 50 million. And that starts to give us that assurance, if you like, that we have manufacturing resilience and the capacity we need to meet our customer requirements. And that's phase 2. And then obviously phase 3 will be, when do we need to go for the investment to take ourselves from 50 million up to 75 million. And I know what I want to do is that with the remaining time I've got, just take you through the process flow and take that forward and go through it in a little bit more detail, but hopefully not too much, so we can keep the speed of the presentation right, and then take questions. So the factory itself, from an aerial point of view, it looks a little bit like an L shape. When you overlay a plan view of that, you can see we have about 55,000 square feet facility. And as and when we put all the kit in there, it should be capable of doing about 75 million of capacity revenue. Now, our original plan was to go with OEM cells, and we'd originally invested in OEM cell 1, and then we said we would subsequently add cell 2, 3, 4, and 5, building our capacity up as and when we required it. And we changed our manufacturing strategy, so that was the original plan. Sometime last year, I think it was September. And the reason we did that is because we need to be building our capacity arguably sooner, as that demand wave was coming towards us. And we need to be ahead of that wave by about 12 months. And we had the opportunity to change from a cellular plant to a process flow or a plant flow. And that plant flow, as we designed it, did away with all of our cells, made the whole plant one production line. And it also gave us the advantage that by doing this, we could bring that timing forward a little bit for increasing the capacity. And we could do that at no extra cost. So we could go from what would have been sort of 20 million to 35 million steps to put in cell 2. For the same money, we could get up to 50 million capacity by going to this type of approach. It reduces the disruption as well in terms of adding that capacity. So we're not disrupting the factory too much. It gives us flexibility in the adding increments of capacity going forward. And there's obviously the lean manufacturing approach that if we're using, rather than splitting it into cells, using one plant flow, it's much more efficient in terms of the use of our labor and so forth. And it also allows us to start standardizing where services were going rather than having them dotted around the plant as well. One of the benefits from that is we've been able to talk about having new technology furnaces in there. And that's certainly helping us with our carbon footprint and our energy usage, which is obviously very beneficial from an environmental point of view. So that's how the plant will actually looks now, with a plant flow going through it, flowing through the carbon fiber hall, through a carbon store, through ceramics and assembly, and then through to completion. But looking in a bit more detail at those steps as we go through it, first stage is where we needle a fabric together, and we needle that fabric in a sense to make it from a 2D dimensional structure into a 3D dimensional structure. There's a lot of technology in this. It took quite some time to put the whole thing together. But it now works well, and the machine that I'm showing there is good for phase 1, up to 20 million of capacity. And then if we move into phase 2, we'll be just replicating that with some enhancements with the second machine. And that's an important thing, because one of the themes of what we're trying to do here is not just building capacity, but building resilience. And so one of the areas where if we only have one machine available, one of the risks we run is if that machine has a breakdown, what do we do in terms of resilience? And that's why we're always looking to add a second machine in phase 2 to build our resilience as we go. So that's stage 1. Stage 2 is carbonization. So after we've knitted those fibers together, we need to convert those fibers into carbon fiber. And we do that in a hot furnace, if you like, a batch process where we put those parts in. We burn up all the organic material, which leaves us with pure carbon remainder, but in the fiber form. And as I say, we have a furnace that's already in place. That's good for our 20 million. And then phase 2, we've ordered a furnace to go in, which will take us up to 50 million. And again, not only will it give us that, it'll give us some manufacturing resilience by having that second furnace available. Stage 3 is where we then do a process called chemical vapor infiltration, or CVI for short. And again, we've had a furnace installed for CVI. This is the furnace I think we talked about in December, where it was a complex furnace which had a couple of issues. Those were resolved quite quickly in January. And we've been able to then install that. But again, we only have one of those, which is good for 20 million of capacity. One of the key things here is everything's automated and controlled to give us the product we want and the process control we want. We're now replicating that in phase 2. And we're adding 2 more furnaces to get us up to our 50 million capacity and give us that capacity resilience we need. And that really completes that first part of the plant, if you like, in terms of fiber and carbon hall. We then move through to that ceramic hall I showed you, where we start, and at that point the material is a generic material. It's a bit like a polo mint. We haven't actually cut it into any shape yet, so it can be allocated to different customers. But at this stage, the material is relatively soft, so we start to cut it into a design which we are committing to a customer. And we do that using CNC machining centers with particular tooling in there and programs and speeds and feeds that we've designed to make the process efficient and productive. We have 4 of those in place to give ourselves phase 1 capacity. And similarly, to move up to phase 2 for 50 million, we'd just be adding more CNC machines to allow us to do that. And that would give us the resilience as well. Phase 5 is where we move back into some furnace technology. Here we've got to convert that carbon that we put down in the material and convert some of that into a carbon ceramic. And we do that by a melt infiltration process. Our melt infiltration process, again, is another hot process. We have to melt the metal. And then we use the carbon effectively as a dry sponge and dip it into the liquid metal, and then the metal is sucked up through capillary action into the part to give us the carbon ceramic disc we desire. We have these furnaces in place for phase 1. We actually have a lot of these furnaces already in place as well for phase 2, and those furnaces will give us our phase 2 capacity of 50 million. Now we sort of have all the material pretty much done there. There's one more chemical step that we're going to go through, but we've now got a very hard carbon ceramic material which needs to be finished so that it can be put together through the assembly line. And again, we've done most of the machining prior to this stage, but there is still some final machining we have to do to get it into the drawing spec we have. So we have a particular set of diamond tooling that we use for this, and that's took quite some time to develop, because the hardness of this material is almost as hard as diamond. So the only thing harder than what our material is diamond, and we use diamonds to cut it and mill it and grind it. And we have those CNC machines in place to do that for the 20 million. And then again, to scale it up to the 50 million and give us that capacity resilience we desire, we'll be adding more machines to the footprint that we already have. Takes us on to the final chemical step, which is an antioxidant coating and an antioxidant impregnation. And we have a process which is effectively a dipping process and allows the material that we apply here to impregnate the disc, attach to the carbon and protect it. And really we're trying to protect that carbon because carbon will oxidize at temperatures about 400 plus. Brakes on cars get much hotter than that. So this antioxidant treatment allows the carbon to withstand those temperatures much higher, and gives us the benefit of endurance as part of the life of the disc. And I should say that process is good for not just the 20 million, but up to the 50 million as well. And the resilience there is in that capacity that we have. It'll only run when we need it. And if we need to run it for more and catch up time, if we've lost any, we'll have the capacity available to do so. That's finished the chemistry, if you like. We now have to put the whole thing together into a component. And that component starts with assembly, where we design the whole part. We then assemble the bell, alongside with the rotor to make it into a proper brake disc. We have an assembly jig that does that. That's good for 20 million. Again, to give us that resilience and up to 50 million capacity, we just replicate that and create a new line. Moving on, we do a final grind to reach the tight tolerances that we have for the product at the end. And this is down to the very small levels of microns, if you like. So we mentioned there that we work to certainly less than 10 microns, probably close to 5. And we have a machine in place that does that up to 20 million, and we replicate it again to give us the resilience to 50 million capacity in phase 2. And then the final step is balancing. This is a rotational part on a car, so any out of balance when it rotates will be felt in the car as a wobble, a vibration. We do a final step where we, rather than on a wheel, they add weight to balance the wheel, you'll be familiar with. We take weight away, so we spin the disc up and then machine a slot if needed into the side of the disc. And this machine is already in place, the 20 million. And again, phase 2 would be to replicate that and to replicate the whole assembly line and give us the resilience we need for 50 million. And then the final slide, really, before I wrap it all up and take questions, is to say the bridge then to phase 3, which would be the footprint for 75 million. You can see we've highlighted areas within the overall plan where we would add more needling machines, we can add more CVI machines, we can add some more CNC machines in the ceramic lines, and then we can add an extra assembly line at the back there. And that will take us from the 50 million right up to the 75. So it is well understood how we would then make the investment needed to take us from 50 to 75. And it's utilizing the similar technologies that we've already employed across the whole process. So I appreciate I've probably gone through that really quite quickly because I know the questions are probably more valuable than me talking. But the investment summary is we have a sustainable recurring OEM contracts in place. We're in a market that fits very well with our products, and we have a market leading product. So therefore, we've got some successful contracts now coming through for multi-year approaches, gives us good margins of profitability. And that should we expect, if we are successful in winning carryover and pipeline models, we'll take up all of our factory capacity of 75 million. The plant flow we've moved to has been successful from the cellular point of view. We're progressing that capacity from 20 million through to give us that resilience, which capacity with 50 million, which we're investing in, and the majority that's done. And then obviously I've talked about the 75 million capacity available in terms of a footprint. And then from a business side, we're working this year through the launch with OEM 8. That gives us that high growth from all the contracts we've got with an order bank of 180 million across 5 customers. And we can see that outlook going a little bit further out. We can talk about having growth above 20% in 23, 24, 25. And then a return on sales greater than 20%, if you like, in 24 and 25, because we're ramping up through this year and next year. And that's really the story. And I'll stop there and I'll hand back over to David, who will chair the questions.
Let's start. We've talked a lot today about strategy and the high level stuff. Can we start our questions with the more mundane issues? And I'm going to have this to pass this to Michael about what's just happening at the moment on question: how is inflation in raw materials, wages, supply chain disruption? How are those issues that are all over the papers? How are they affecting our business, Michael?
Yeah. This is one of those things. Obviously, there are some increases coming through. We can see that coming down the line, and I think if we were a stable automotive firm working in small margins, then we'd have an issue there actually. However, we're still in a place where we're looking at bringing our costs down within our product and for our processes, and so many of those things that we have seen increasing, we have already got in place programs that will counteract those. So whilst we are obviously like everybody else exposed, we have enough actions that we can take to mitigate those, that we feel that there's no real impact certainly in the short to medium term as regards our profitability at a gross margin level.
Yes, I'd even simplify that. We've had in place a cost reduction program for a number of years, and we've halved the cost, and we're going to halve it again in the next 5 years. We saw that as a means by which we would actually increase the size of the market, because we're clearly in a price elasticity situation. The threat to us is not that margin, not that at all. It's the fact that the pace at which we can reduce our selling prices and keep our margin is the concern we have. But we've got plenty of opportunities to do something about it. Can I move on? I'm going to stay with you, Michael, and then we will go back to the strategic stuff. Another question that's come in about shortages. Almost every part, and this is all over the papers. I was listening to the Today program this morning, and almost every part supplier in the auto industry has complained about shortages of something. Has this affected, delayed any contract wins you might have expected to make?
I don't believe it has. I don't believe it's impacted anything that we're working on. And actually, from my experience within the automotive sector, my gut feel on this particular one is that the vehicles that we're being applied to at this point are generally manufacturers' highest margin vehicles. So when they're prioritizing their own manufacturing, they are prioritizing the vehicles that we naturally sit within. And I think there's been recent articles within the press on that subject as well, actually highlighting that the revenues might be going down within the automotive sector, but their profitability is actually holding fairly steady because they are selling higher margin cars. And actually, those are the ones that we're currently sitting on.
Yeah, but basically the industry switching to our segment, isn't it? Kevin, do you want to add anything on this? And I'd put the wider subject, all the stuff that's in the papers about gas, about cost increases, about supply chain shortages, about all this. Is it affecting our business?
Well, I think Michael's absolutely right. But I think what we do talk about is gas is a raw material. Gas in particular is one thing that we keep a close eye on. I think Michael would tell you that we always buy fixed price forward contracts on gas, and so the gas price fluctuations that we've been observing over time, haven't affected us to date. I think our gas contract runs out sometime early next year. So that's probably the most relevant one and closest one to us in terms of what's going on and ones that have been mentioned. It isn't affecting us now. We actually think we've looking at forward beyond sort of next year. We are looking to put some forward contracts back in place, which will give us some assurity and certainty to what the price is, because there's no doubt the price has gone up, but we already know roughly what we think the pricing will be for sort of 2-3 years out, and we've factored that into our costs already, if that makes sense. And we've already offset it with some of the cost reduction opportunities that you've already highlighted, to say that there's a lot for us to go at, and that will continue to be the case. But we are at the very early stages of, we have focused on product rather than efficiency of process, and now the switch can go from product to process efficiency, and that will continue for years to come.
Okay, I hope we've dealt with the issues on our short-term things. We are, like everybody else, we're not insulated from it, but we're frankly some distance from having any concerns about it. I'd like to move on to the other. There's a group of questions here about capacity, Kevin, and it appears, again submitted before the meeting, it appears a major threat to the company's future success is the rate at which production capacity can be increased relative to escalating market demands. How are you addressing this?
That's the exact question.
I think that's the exact question
we've been trying to answer. I think the manufacturing resilience that we all recognize we want to have, where we have a daily build rate every day on average that works out to be the same, will fluctuate from day to day, but the manufacturing resilience allows you to average that out. I would say we are addressing it now. We've got risks on us now, so we're not quite there yet. Is the simple answer to say in the short term, that's what we're working on. But the plan is in place to allow us to get ahead of that demand curve with our capacity. So the objectives for this year and next year is to keep going, keep working hard, and
Yeah,
eventually we'll have that resilience in place.
yeah. I think it was a closing statement in our annual report where we said that we're into risk mitigation on capacity, and the risk mitigation is as simple as having the capacity and the people in place a year before you need it. And it really is as simple as that. Congratulations on all the progress you're making, including all the OEMs. Are you able to give any ideas about how much and over what period your capital spend is going to get you to that 75 million capacity? In other words, you can answer the 50 million straight away. That won't take long. And when we get to the 75 million, how much of this, and this is a question has appeared a few times, how much is that the increase in capacity to go from 50 to 75 going to be self-funded, debt financed, or are you going to have another placing?
So I think I'll pick this one up. So look, the question as to whether it's equity or debt is really dependent on circumstances and relies completely on when contracts land with us. We're if we want a really large contract tomorrow, we would be in a position where we would have to look at equity. But the truth is, if we land carryover contracts over a continuing period with our existing customer base, then there's probably a good chance that would be self-funded, and we'd be able to work through that through both free cash flow and some lower levels of debt. Obviously, until we've got a significant profitability level and we can absorb good levels of interest cover, you wouldn't want to go down a heavy debt route, but we'd certainly be able to fund from free cash flow and debt. And as regards how much to get to the 75 million, it's not, we can ramp up in 5 million increments because we buy a CVI furnace and then additional CNC machines, and we can take that up in increments to get to where we need to be. So it's not just a big splurge like we've had to do in the past.
I mean, right now, we've been financed to get to 50 million, and when you look at that demand curve from the customers, that looks okay. Frankly, it looks like by 2023 we'll have that capacity in place, and and then, as you rightly say, it's more looking further out than that. Now, two things always happen. We get sight of contracts 2 to 3 years in advance from customers, so it's really looking at sort of 2025 and saying what's the demand like in 2025, and we need a couple of years to be able to put that capacity in. So we are always looking at it, if you like, but I think we've got time. The first thing to say is there's a little bit of time before we need to make any decisions for 2025, 2026. So I think that's it isn't something we're ignoring. It's on our planning sheet, and it always is on our planning sheet, but it's more towards the end of this year we need to make those kind of decisions than now. And the other thing is there's always uncertainty to when those contracts come in. One thing I can say about virtually all of our customers during the COVID period is that they've all been late, and that matters in terms of how you fund things. So if all of our customers were on time, I think you'd say, well, we could plan things very, very well, but we also have to plan for the assumption that certain things will be delayed or late or put back a little bit. So that's something to be considered as well.
So what testing is done on the end product pre-release from factory? What failure rate has been seen? I guess that's in the field. And what testing has been done by customers?
Let me talk about the in the field first of all.
Control.
Yeah, we don't get failures in the field, and that's principally because everyone does a lot of testing prior to that. So the testing is extensive by ourselves and our customer. That's partly the reason why there's a 2-year time gap normally between being sourced and awarded a contract to then going into the product launch on the car. So all of that testing is done in terms of pre-launch. If I take the launch of the OEM8 car this year, all that testing gets done by us and then by the customer. We both verify each other's work, and then we can go into launch. So we're in good shape in terms of that contract. But we don't do it all again. That's what the benefit of carryover is. But we do a significant amount of testing then on each of the contracts we have and each of the models we have. And then I think you were saying what happens, what the question testing is done before release of product. I mean, the best way to answer that is not in the detail of that, because we do all kinds of tests and all kinds of measurements. What I can say is that this product, it's a safety critical product for a car. Nothing should go wrong. And because of that, we do 100% check of every single part that goes out the door across a number of parameters. But the detail of that, it's too detailed really to give people over a video. But everything is checked. Every single disc before it leaves is checked and tested.
Yeah, I'd add to that, Kevin. In fact, every operation is checked.
Yeah.
You know, I mean,
Yeah, I know. Yeah.
You machine something, you check it.
Yeah.
When you CVI it, you check it.
Yeah.
And what you do at the very end is you check the product. But it would be most unusual for failed product to get out.
Well,
one of the questions was what sort of volumes have gone through the 20 million plant.
Has gone through the 20 million plant, and you know, that will continue. So that 20 million capacity that we talk about, there's still work, there's still work to do on our resilience. You know, we illustrated that in December of last year, where we had the furnace go down and we weren't able to cope with that. So all of our products go through that 20 million of capacity. It's just a case of being able to make it work more. And I think your phrase, David, which I quite like, is make it work like a Swiss clock rather than just any old clock. And that's what's needed this year.
And so the recent appointment of Ian Clements has solid UX experience with new orders coming mainly from the US. Does this change your thoughts on US exposure for production and foreign exchange? Possible US listing? I'm going to answer that. We're doing no work whatsoever on US listing. I mean, there isn't a technology company, we regard ourselves as a technology company. There isn't a technology company in the country that doesn't look with envy at the valuations in the States. But frankly, we've got enough to be getting on with our day job at the moment. And we appointed Ian, not because he happens to be have had 20 years experience in a NASDAQ quoted company. We appointed him because he's had 20 years experience as the chief financial officer of a quoted US company. And it's that experience of a large international company that is relevant to us. It's not the US listing per se. And in fact, I'll pass this one over to you, Kevin, because it's the same question asked in a slightly different way about, is there any prospect of increasing the manufacturing capacity beyond 75 million at the current location? And this is from Charles Cousins. If not, where would your first choice additional location be sited? Given the depressed nature of industry and location, would you seek to locate nearby?
That kind of question is on our planning list right now. So, and as I said earlier, we've got time to think about it and work it out. You know, there are some fundamentals that are inescapable, if you like. We have a significant amount of our volume will be going through the US. We also know that in terms of power, security of supply for power and gas, and the cost of power and gas, which are two things that are important to our two key inputs to our product, they're significantly cheaper in the US as well. So I don't think we're giving any secrets that there's a lot of arguments to say that it's quite attractive to talk about a US factory. But that said, I don't think we're there yet. And we need to look at what we want to do and how we want to do it. And I think just jumping in and saying, well, we might expand over abroad is too simple an answer. And I think we need to look at it and look at a bit more detail and a bit more nuanced to say, what can we do in the local area? Are there opportunities there to expand? And we may well have that opportunity to do that. And then in the fullness of time, we might then say, well, we need to go further. But it's too early to say, but all those options are available to us.
Yeah, the only thing I'd add to that is let's not talk about expansion at the margin. I mean, could we go from 75 to 100-ish locally? Yes. Could we go to many times that number locally? Probably not. And our ambitions, believe me, do not extend to the margin. Our ambitions are global, and they are to be a major supplier. But we'll deal. Let's deal with that when we come to it. The other question really is this one, Kevin. I'll leave you to answer. It's the question about aerospace. Surface Transforms has carried out a significant amount of development work. It says with multiple aircraft braking system companies. That's not actually true. Why has this been less commercially successful than work in the auto sector?
I think the simple answer is because the aerospace sector is far slower and far more sort of niche than the automotive sector. But to give you a bit more detail to that, there was no reason why our technology couldn't be used in a particular aircraft application that we were working on. No reason at all. But it wasn't down to that. The drive to put it on that aircraft has to come from the market and the customers, and they just move incredibly slowly. And we've got much bigger things and much more exciting opportunities to work with on the automotive side. So I think events overtook that opportunity because the dynamic. I mean, it's a bit ironic to call automotive dynamic. They're not that dynamic, but they are dynamic compared to the glacial speed of aerospace. So that's the simple way of putting it. It didn't go away. It just never happened.
Yeah, it's also worth making that the return on the engineering effort in aerospace is terrible by comparison with the return on the engineering effort in automotive. The aerospace volumes. I mean, I think the 8th when I was there. And let's not forget, I spent 10 years in the aerospace industry as a divisional MD and latterly chief operating officer for Lucas Aerospace. For them, high volume is something like 10 a month. I think that's the A320. It might be more than that now. For us, we're sort of currently trying to get 100 a day, and it's virtually the same. In fact, you could argue there's more engineering effort in aerospace. So it wasn't unsuccessful. It was almost a choice, actually. I mean, we didn't actually get that one, but we choose not to go into aerospace. We've got more than enough to do in the automotive industry. Look, I think we've answered most of the questions. There's somebody. I'll answer one actually because it won't take me long. It's David, who says, "Who supplies the CNC machines?" And the answer to your question is, we're not telling you. No, so on a very, very serious point, who we buy our machines from, who our suppliers are, we regard as commercially confidential information. And just as Brembo won't tell us where they get their machines from, we're not effectively through this public domain, not telling anybody else where we get them from. But there aren't that many CNC machine manufacturers, so we're not keeping it particularly tight secret. We would like to thank you very much for taking part in today's webinar. I hope you found it interesting. I hope it is of some comfort to those who were not able to attend the oversubscribed Capital Market Day. And of course, just a reminder that because we were oversubscribed, we are going to have another one on July the 7th, I think it is. Correct me if I'm wrong, gentlemen.
No, that's right.
I think it's July the 7th. And as before, there's a website if you want to register and come and have a look at us, and we can answer this a bit more in a bit more detail. Thank you very much indeed. I think we've answered everything else, but please answer your question. And last but by no means least, thanks to Hardman for all their hard work in facilitating this talk. Thank you very much, everybody.
Thank you.
Thank you.